Hello and welcome to this Later Life Lending Symposium event brought to you by Air Group, More to Life and Key Partnerships. My name is Stuart Wilson and I'll be your host for this event. And it's fantastic to have so many advisors online with us today. We've had over 800 people register for today's event, an extraordinary number and a testament, I think, to the quality of content and speakers we have lined up for you. We have a packed agenda for you today with some fantastic guest speakers joining us both live in the studio and via video link, and I'll run through the lineup with you in just a moment. Now, the purpose of today is to provide you with expert insight and information designed to help you grow your business in the later life lending market. And to help us do just that along the way, we'll be joined by a range of subject matter experts who'll be sharing their unique insights and knowledge, some of whom will be joining us at the end of the day for a live question and answer panel session. Now, before I get into the agenda and onto our first presentation of the day, I wanted to run through a few points of housekeeping in order to explain how today's event will be run. We're live streaming this event today as one continuous program, so you just need to keep your device connected to this stream throughout the day. We'll be taking regular breaks to allow you to grab a drink and stretch your legs, and a lunch break too, but if you're unable to rejoin us for any reason and you miss some of the content, don't worry, you will be able to catch up on demand with every part of the show. And as I just mentioned, there will be a live question and answer session at the end of the show, but don't feel you have to wait until then to pose any questions that you may have. You can use the Q&A window on the dashboard that you've logged into to watch this program to submit your questions to us. And don't forget to post your comments on today's events via Twitter or LinkedIn using the hashtag #SymposiumLive. We'll be posing some questions throughout the day to give you the chance to win some goodies, so keep your eyes peeled and your social feeds at the ready for your chance to win. And speaking of prizes, we have a unique prize on offer today to one lucky winner worth over £7,000. It's a prize the like of which has never been offered before in this industry, and we are delighted to be bringing this opportunity to one of you today. So stay tuned for more details of that later in the show. Our show today provides you with accredited CPD, and you'll be able to download your certificate automatically from the dashboard once you've watched at least 30 minutes of content. Our learning objectives for today's symposium are: number one, to learn about the key thematic challenges that face the later life lending market as we move through the latter stages of the COVID-19 pandemic. Number two, to understand the issues relating to advisor development, training and competency in light of the FCA's focus on equity release. Number three, to gain insights into the views of advisors working in this market and their commentary on the opportunities that lay ahead. Number four, to discover insights, hints and tips designed to improve an advisor's marketing campaigns and improve lead generation quality. And number five, to learn more about the later life lending market through market insights, statistics and data taken from market-specific research. Okay, so let's get into the agenda for today and introduce our first speaker. Now, it's fair to say that 2020 was an exceptionally challenging year for this industry and everyone involved in it. Total lending for 2020 ended at a similar level to 2019 and marked the second year of stalled growth in a market that had, up until that point, been growing at double-digit rates for several years. But with the vaccination rollout now in full swing and a roadmap back to some semblance of normality now laid down by the government, there are signs of a return and a resurgence of consumer confidence, with lending volumes in the last 6 months looking more similar to pre-COVID levels. Against that backdrop, what is the outlook for the market and what challenges lie ahead as we continue to navigate our way through and out of the other side of this pandemic? To help us address this question and to frame the rest of the day, up first we have a presentation from David Burrows, Chair of the Equity Release Council, as he gives his view on the current challenges and opportunities emerging in this market. David will then be joining me and the other Stuart Wilson of the Equity Release Market, CEO of Air Group, and also Steve Groves, Chair of Retirement Bridge, Mobius Life and Key Group, to explore some of these themes in more detail. A little later on, Stuart and I will be joined by Paul Soroya of Viva Retirement Solutions and Mark Orme from the Equity Release Experts to give us an advisor perspective on the growing opportunities in later life lending and the key issues facing the intermediated market as we move through and out the other side of the COVID-19 pandemic. After a short break, we'll be back when I'll be joined by Tish Hanifan from the Society of Later Life Advisors, Matthew Jubb from UK Finance, and John Somerville from LIBF. Now I'll be asking for their views and insights into the topic of later life advisor training and development, improving consumer outcomes, and their members' views on the points of concern recently raised by the FCA in their Dear CEO letter that they issued last year to mortgage advice firms. We'll then hear from some of the team who help advisors access the products and services on offer from Air Group, More to Life and Key Partnerships. Names and faces many of you will be familiar with, I'm sure, as we're joined by Kay Westgarth, Hema Patel and Kerry Young. At that point, we'll break for an early lunch, or for those of you whose body clocks are well and truly adjusted to the lockdown way of life, a second breakfast. But keep your device tuned to this broadcast, as you will not want to miss the lineup we have coming up this afternoon. In the second half of the show, we have three fantastic subject matter experts for you. First up, we'll hear from Chartered Financial Planner Pete Matthew, as I talk to him about how he has used digital marketing to build the hugely successful Meaningful Money brand and how that's transformed the lead generation activity of his business. We'll then be joined by Phil Calvert and Phil Bray, two of the financial service industry's leading marketing experts, as they explain how advisors can fine-tune their marketing skills to generate higher value, better quality leads. Phil Calvert has run sessions for us at previous symposium events with some fantastic feedback from advisors. And Phil Bray has recently helped us deliver two highly successful marketing masterclass events for mortgage brokers and financial planners. If you want to learn more about how to improve your marketing skills and lead generation techniques, you are going to want to stay tuned for all three of those sessions a little later today. We'll finish the day with a question and answer session featuring some of the guest speakers who will be appearing on the show today. Remember, you can submit your questions using the Q&A panel on your symposium dashboard at any time, or by sending us a message via Twitter or LinkedIn using the hashtag #SymposiumLive. Now, to get us started and to set the scene for the rest of the day, I'm delighted to introduce David Burrows, Chair of the Equity Release Council, who's going to give us his perspective on the current status of the equity release market and his views on the opportunities and challenges that lie ahead. David, it's over to you.
Well, thank you for that introduction, Stuart. It's great to be here for the Later Life Lending Symposium. As you'll see, my name is David Burrows. I'm Chairman of the Equity Release Council. Last year, recall we were hoping to meet in the wonderful Gherkin for the symposium with a beautiful bird's eye view over London, but sadly we ended up in our own houses with only a view over our neighbours due to lockdown. The remote symposium then was one of the first online events of its kind in lockdown, and now aren't we? We're all, for good or ill, pretty much old hands in this digital world. And Stuart's already mentioned it, but last year was obviously, of course, the most remarkable of years, which brought with it lots of new challenges and opportunities, as well as the continuation of some of the old ones as well. But one of the words I would use to describe the last remarkable year is resilience, alongside collaboration. Because over the last 13 months since the first lockdown, the market has shown itself to be remarkably resilient. When last year's symposium took place, there was no real data to measure how activity had fared in lockdown, and anxiety was high. Only this time it was despite the pandemic and the economic shock it brought with it. There were several things that helped us, including, first of all, in Q1 of 2020, seeing the highest ever lending figures for a first quarter. In fact, it was the second highest quarter ever, indicating that pre-pandemic we were really heading for a record-breaking year. The big factor, though, that I want to emphasise that enabled this resilience was collaboration across the later life lending community. Like across other parts of society, COVID brought out a spirit of working together. And for us at the Council, we were able to respond quickly to the challenges of lockdown by drawing on our members who go across the value chain, from funders, lenders, advisors, both financial and legal, and surveyors. It involved a rapid consultation and obviously a great deal of collaboration with all our members, as well as key stakeholders like the Bank of England, the FCA, the Treasury, and indeed the Law Society, because this enabled changes then to valuation processes and support non-face-to-face advice, including, crucially, the Council's own legal advice requirements. I know as a lawyer myself, getting a bunch of lawyers in the same virtual room, as well as them actually coming to an agreement without even a fee, is not usual, but these were unprecedented times, and the availability of equity release frankly relied upon it. So we agreed to temporarily revise our rules and guidance to enable remote legal advice without the usual physical face-to-face meeting with a solicitor. And our recent member survey showed that 95% of respondents strongly agreed that the measures were vital for keeping the equity release market open during COVID-19. We also, you'll of course be aware, so that shift in working practices, while many frontline advisors would have already been well used to working from home, there was literally a Herculean effort which I want to pay tribute to everyone, not least those you listening in now, to get the whole value chain operable in lockdown. As you'll know all too well, there's now also an opportunity to carry on with some of the working efficiencies made during the pandemic. Naturally, not all the challenges have been COVID-related, and indeed in June, the FCA released a report on the equity release advice and sales process with a number of challenges, and then towards the end of the year, there were letters to CEOs of providers and intermediaries, which I'll pick up on a little bit later. But despite all these headwinds, we saw customer numbers and lending activity increase in the second half of the year as consumer confidence and business operations showed that resilience in the face of uncertainty. And early signs from our Q1 are showing from industry data that the market's stable recovery and resilient performance has continued in the early months of 2021, despite the return of lockdown. 2020 was a watershed year in many ways, and our industry responded with resilience and collaboration, showing rigour and care to ensure an important source of later life finance remained available to those who needed it. Now, 2020 showed us many things, but it also showed us that the drivers for growth remain, and namely those are the Council's standards and protections, the socio-economic challenges we face, and the product innovation that helps meet those challenges, which I want to discuss now in the next few slides. And for the benefit, though, of anyone who's new to the sector, indeed the Council, it's worth just briefly reminding ourselves of those Council's standards and protections. The Council is a trade body, and by joining the Council, our members must abide by our standards and principles, which are customer outcomes focused and overlay and supplement FCA regulation. Customers of our members benefit from those four key well-known protections: the no negative equity guarantees, security of tenure, freedom to move to any suitable property, and independent legal advice. And thanks to these standards, the sector has turned a corner after that bad reputation back in the 80s. And the sector is now highly regulated and underpinned by industry standards. But none of us are complacent, and we are continuing to work proactively to support good consumer outcomes with toolkits for our members, and seeking to regularly revise and evolve our standards so they remain current and relevant and fit for purpose. Indeed, as I mentioned in June, we saw that from the FCA report, there was on the one hand recognition that equity release is working well for many consumers, but they underlined the importance of ensuring advice is tailored to customers' personal circumstances in every instance and properly evidenced. We regular engagement with the regulator to understand those concerns and ensure that they're informed and up to date as possible and understand the sector. We've been conducting our own review of the Council standards and all associated materials to ensure that it reflects properly the FCA's latest feedback. As part of that work, we've expanded the advisor checklist and produced a good practice guide for our members, both of which support a highly personalised approach to the advice process. And we're seeking to constantly review those standards and protections to ensure they remain fit for purpose and deliver good consumer outcomes. And we'll use that to take account of the latest regulatory thinking in terms of the next iteration, and also respond properly to those letters to CEOs back at the end of last year. So moving on to the next driver for growth. Another key driver for growth is, of course, the socio-economic challenges that we are facing. The context, of course, is property wealth, which accounts for 31 pence in every pound of the UK's 55 to 64 assets, which should mean that equity release plays a bigger role in holistic retirement planning. Concerns around the ageing population, inadequate pension savings, and the reduction of defined benefit pension schemes are perennials for our industry. But the pandemic and the lockdown brought some particular issues to the forefront. We've long since known that there is a strong desire for people to remain in their homes as long as they can. With a report we produced in collaboration with My Care Consultants and Pure Retirement entitled Solving the Social Care Funding Crisis, found that the pandemic has left 2 in 3 over 50 determined to receive care at home. Yet half have not thought about how to pay for future care needs, while only 12% of the over 50s have made any plans or provisions. As we know, the country is crying out for a care funding plan that's fair for all and sustainable in the long term. But property wealth can play an important role in resolving these generational crises. Meanwhile, the important pension property paradox reports produced with Key found that women, particularly approaching retirement, are facing a confidence conundrum. They're most anxious about being able to afford a comfortable retirement, yet are the least likely to consider alternative funding options to plug the gap. In fact, the proportion of over 50s worried about running out of money in retirement increased to over a third over the last year. While concerns are rising fastest among men, working women remain the most anxious. So again, this very complex problem that needs a long-term and sustainable solution. It's all what we want to ensure, though, is that people can, where appropriate, tap into property wealth in their homes as a safe and sustainable way in one part of dealing with this equation. So our role in the council is to bring this issue to the heart of policy and decision makers, such as just a few weeks ago, a webinar with key support with the chairs of the Parliamentary Work and Pensions and Work and Equality Select Committees. The council aims to support the market to create a virtuous circle whereby we as a sector identify challenges and respond to them, and then through collaboration with those key stakeholders, internally and externally. And also, product innovation plays a very key part and is an important driver of growth. And so moving on to that issue of product innovation, our latest market report found that despite the challenging environment, the second half of 2020 saw equity release product options rise to record highs, with over 100 products added in 6 months alone. Consumers considering equity release now have almost 500 flexible options to choose from. Over 3/5 of lifetime mortgages now allow voluntary partial capital repayments with no early repayment charge. And products, as we know, are competitively priced, with the average lifetime mortgage interest rate reaching a record low of 3.95% in January 2021, with a quarter products now offering rates of 3% or lower. These improving rates for the last 5 years could indeed, we've articulated, reduce a lifetime mortgage customer's interest cost by 35% before taking into account extra product flexibilities. Much like the sector that it's proud to represent, the council has shown that it's resilient too. And in fact, more equity release professionals turn to the council in these extraordinary times than ever before. During 2020, we experienced 15% growth, and it's heartening to know that membership was valued so highly during such a difficult period. We saw several major firms joining the council, including Scottish Widows, Phoenix Group, eServe, and the Pension Insurance Corporation, amongst others as well. And the council bolsters its own internal numbers as well to ensure that we can properly represent our members and keep pace with the demands of an increasing vibrant and innovative market. We recruited a business development and member relations manager, public affairs manager, and importantly, a risk policy compliance team to make sure those standards we spoke about earlier are properly meaningful. Another key initiative to highlight that was rolled out during this pandemic was the council's Competency framework, which provides an education syllabus with 3 pathways based on advisors' level of experience, designed to guide their development journey by benchmarking their knowledge and skills, as well as signposting materials to support their progress. The council's worked very closely with specialists across the sector over a couple of years now to bring this to fruition, including Canada Life. And they've all helped together to play a key role in the production to develop 6 in-depth modules which have been piloted in the field. And just to finally mention, last year we formed a funders forum and a legal forum to provide special advice in relation to later life lending in these important areas, as well as obviously on the ground providing those toolkits of the advisor checklist and good practice guide. So we've been busy on our members' behalf, indeed not just our members, but we believe on behalf of the whole later life lending community. And another initiative which won't go unnoticed, not least in these slides, is there to see our brand refresh and member endorsement mark, which is just producing a new look, but wanting to ensure that what we're about is a mark which is there to show a badge of trust for not just members, but customers to look for when choosing equity-release products and advice, being proud to be a member of the council and a recognisable statement of quality. Designed to offer what we're all about, aren't we, to ensure confidence and reassurance for consumers, a commitment to quality and professionalism in the products and services that are offered. And that mark and that refresh is all about trying to ensure that we're part of an innovative, vibrant, equity release and indeed later life lending market. So looking ahead, with this more personnel and renewed and refreshed focus, we're ready to stand alongside others to provide greater service to members and customers. And this risk policy and compliance team I mentioned is ensuring that we're keeping our membership up close and personal to ensure that we revise and evolve our advice and product standards, as well as work in partnership with others, not just our members, but other stakeholders, as we seek to open up together the opportunities of property wealth for more consumers. We're therefore working closely with other trade bodies like AMI, UK Finance and TISA to support this collaborative approach to later life lending, supporting agreed definitions, consumer principles and signposting. And as you know, it's often said at the moment, isn't it, particularly in these times, we are really all in this together. We look forward to more collaboration on major new campaigns and reports and remain hopeful that we can eventually, all of us, meet in person like we did last year. Was the last time many of us actually really properly met in person at the Equity Release Summit. And we're looking forward to the next one in early autumn. So together remaining focused on continued engagement with industry, government, policymakers, regulators, consumer representatives to shape the next stage of the later life lending market's evolution. Thank you very much. It's been great to join you today.
My thanks to David for that presentation, and we'll be speaking to him in just a moment along with Steve Burrows. And to help me do just that, I'd like to introduce my next guest, the other Stuart Wilson of the equity release market, CEO of Air Group. Welcome, Stuart. Thanks for joining.
You're very welcome.
How are you?
I'm very good, thank you. Delighted to be here.
So, Stuart, I'd like to pick up on one or two of the points that David raised in his presentation just then, and we'll speak to him a bit more in more detail in just a moment. But he talked there about looking back over the last 12 months and some of the lessons learned. So, from your perspective, CEO of Air Group, what's the last 12 months been like, and what kind of lessons has your club and your membership learned, do you think, from what's happened?
It's been an interesting, and I think that's with a big capital I, last year. The only constant really has been the change. I think nobody has stood still. We've had to adapt. We've had to adapt on a much broader picture with what the country's been through, and within our sector, those adaptations and challenges have been very focused. We've had 12 months where we've seen the regulator do a couple of bits of work, writing to the managing directors and CEOs of firms from the very top big firms right the way down to sole traders. We've seen regulatory communication with lenders on responsible lending practices. We've seen a very focused reality check on vulnerability because of COVID and how that impacts on our customer base. For Air Group, it's been, I guess from a business results point of view, it's been a fabulous year. We set our objectives last January with no clue that COVID was coming at us within a matter of weeks. And despite the impacts of COVID, we actually broke all our objectives, all our targets by the end of the year. So from a business performance point of view, it was fabulous. I guess the question begs, therefore, why was that? Because business was over the whole sector, was down from where everybody thought it would be. The year started off amazingly well. Q1 2020 was above expectations from everybody's point of view, and we were fully anticipating a £5 billion plus market. But that didn't happen. Things slowed down. COVID came in March. I think we went into formal lockdown phase 1. We had issues and challenges around the immediate ability to do face-to-face advice, the legal process ground to a halt, lenders' lending ability and systems, valuations all on day one looked like they were going to cease, and we were on a cliff edge. And then very quickly, and I'm really proud of our sector, how we adapted and moved into an operational status, embracing the challenges that as a country we all faced into, and those headwinds were ever increasing. The legal process was led by specialist firms to make sure that we could do non-face-to-face options around the importance of the legal process with our older consumers. Face-to-face moved and embraced technology. Zoom, and I wish I'd had shares in Zoom before this ever happened, became the default norm, as well as other video conferencing platforms that went from periphery usage into mainstream default everyday use for everybody across all sectors. And then the valuers moved to desktop valuations, working with the lenders. So within a very short period of time, our sector really shone bright as to how, when facing into those stormy headwinds, you can quickly adapt. So really proud of that. And I think for us, what was really quite fascinating, on day one, we adopted a principle of cash flow counts. It was a strapline that we thought was vitally important. And that resonated with advisors across the sector. We had a huge increase in the number of people joining us, the number of advisors using our training, our support, realizing that the deals that we had and the procuration fee deals were the best in the market. Our tech platform made doing the job that much more efficient in these challenging times. So for us, I guess it was a sort of perfect storm scenario that all of those services that we'd built over a number of years all came perfectly into alignment, and it delivered to advisors the ability to do the job working within those sort of cloudy, stormy, rough environments in somewhere safe and solid and a sort of shining light in the darkened room, so to speak. So it's been a year of change. I think many of those changes will stay with us. Many of those new working practices moving forward will continue and expand. At the heart of that, technology, we've waxed lyrical about for years, and that's come to the fore. So it's been a year of change, and yesterday's normal is not going to be tomorrow's normal. So it won't go back to what it was. And I think that's positive, because during times of crisis throughout history, it speeds up the ability of change, and our sector is no different. We've changed, and there are huge lessons and things that we can embrace to move forward and to become a better, more efficient sector, and ultimately better for customer outcome.
And Stuart, if I can just pick up on that point about the lessons learned from, and we heard David talk a little bit about that just a moment ago. From your perspective, what are the key lessons that this industry must or already has learned, do you think, as we hopefully head through the other side of this pandemic?
We've got to take a pause here. We've got to have an opportunity, because lessons can very easily be forgotten, and we can move quickly into a business as usual process. We can move into doing everything as we used to do and assume that it's going to be the same again. It won't be the same. What we've got to be able to do now is pause, deep breath, and actually ask questions of our business. What are we doing? What's the experience with our customer, and how are they facing different challenges now? If we look at this age group, they're going to carry on having health concerns. It's brought transmittable disease into the forefront of people's minds, especially in this vulnerable age group that we deal with. That, just because the government may announce a reduction in restrictions of movement and the ending of lockdown that we're hopefully approaching soon, doesn't necessarily mean that the consumer base is going to change their views. They're going to still be very cautious. They're going to be potentially vulnerable. So I think we've got to take this increased awareness of vulnerability at multiple levels. That might be mental health vulnerability. it might be health vulnerability, it might be emotional vulnerability created by loneliness, and it might be vulnerability created by pressures. One of the things that we're very aware of across the whole industry is, for example, a new demand sector of businesses that have failed, jobs that have been lost, and that moves up the family chain. That might well sit and end up on the table of mum and dad, granny and granddad, and looking at their property as a solution. And they themselves might be very keen to help, but we have to be very aware of that as a sector and factor that into our advice process. We need to factor in heightened awareness of vulnerability. And if we're still going to move forward with using things like video conferencing, then we've got to be aware of how does that impact on things like vulnerability, on coercion, family pressures. Somebody sat off camera may be exerting pressure. So if video conferencing is going to be, and I suspect it will be, a consistent part of the future, then we've got to adapt and make sure that we don't drop the ball on looking after our customers' interests. So there's a number of different lessons that we can apply to today and tomorrow that we've learned from yesterday.
Thank you, Stuart. At this point, I'd like to bring back in David from the council, and also Steve Groves, Chair of Retirement Bridge, Mobius Life and Key Group. Welcome to you both. David, I'd like to start with you, if I may. Stuart mentioned just there the issue of vulnerability and vulnerable clients. This is such an important topic, isn't it? It's something that lots of advisors are critically focused on. We do lots of webinars on this subject, and they're always packed out. What's your take on Stuart's point there and the importance of this issue of vulnerability and vulnerable clients?
Yeah, I mean, Stuart's made a very good point, and it was a point that's been relevant before the pandemic, during the pandemic, and indeed after the pandemic. It's of crucial concern, obviously, across services, not least the financial services, the issue of vulnerability, and dealing directly perhaps with Stuart's point of the heightened concern during the pandemic, not least around the fact that obviously there is remote working, and I referenced in my presentation, my speech, about the fact that with the council we have within the advice process there is this unique requirement to have independent legal advice as well, and I think that's come into its own in many ways. I mean, obviously that process itself had its modification to be remote itself, but we were very conscious in that modification to ensure that there was key consumer protections, not least around the vulnerability and the heightened concerns of vulnerability around who's properly, that ensure the customer properly understands what they're getting into, but particularly dealing with issues of potential duress, issues of capacity. And those are ones where not least a lawyer is very well qualified to be able to ensure that they can certify that they follow through those checks. And so that's an important element to it. It's not the only way. And obviously, as was referenced, that we're all concerned in terms of the full advice process, that there is a proper concern of vulnerability. And we've certainly, from a standards point of view, tried to ensure that that is embedded within our standards, and indeed that is properly evidenced in the whole process, and working within our toolkits to ensure that helps support the advisor community. And also, I think it's worth referencing the fact that this has, and certainly our conduct forum has been involved in trying to ensure that this has an approach where, we don't need to be afraid of tech in terms of vulnerability. We can use tech to work and to help support this key question of vulnerability. And it could be a partner and be an aid to support that going forward. So we've been looking at that area, as well as the wider issue of working across other professional bodies beyond simply financial services, who are also on the same page of vulnerability, to learn from each other collaboratively. In our conversations, not least with, for example, Money and Pension Service and Sector Hans in his work with looking at the whole issue of customer well-being, that is a key vulnerability driver, and also in our work of trying to ensure that from point of competency in our competency framework I mentioned as well, that is very embedded in vulnerability. So it's very much front and center of all our concerns. And I think what this this period of time we've been has recognised it's heightened concerns. There's new technological issues that can be our friend rather than our foe. And we need to very much ensure that we're on the front foot in relation to dealing with people's vulnerability of, as Stuart mentioned, which comes in all shapes and backgrounds and sizes. And indeed, it comes with the extra other element that dealing with the issue of in our demographic and dealing with issues of the different asset classes, there are added wider vulnerabilities. I mentioned in the property paradox, pensions paradox, that Key have been very involved in and highlighted the concerns for women, particularly in this area of confidence in retirement, where they have extra vulnerabilities given the disparities that were identified in that report, that we need to be particularly aware of and cognizant of, and show that the role of later life lending plays a crucial role in helping support the wider vulnerabilities that this demographic feels, but also dealing with some of those particular points as well.
And Steve, if I could bring you in at this point to give your take on that issue of vulnerability and vulnerable clients, and how this industry focuses on that really important subject.
I think Stuart makes some really interesting points there, and there's certainly things I've seen in the past, having worked in particularly the long-term care side of insurance. If you look at the vulnerability that the customers exhibit there, you clearly see the medical conditions that are putting them in care. You see potentially financial capability and things like dementia coming up a lot. But actually, you also see massive family pressures. There is inheritances in play, and people are put under very significant pressure to avoid committing capital. I think when you look at how that evolves in the modern world, where you see things like Zoom as the preferred method of delivery of advice, I think if we're going to evolve the process from a tech point of view towards things like Zoom, then it's actually quite important that a lot of the safeguards and the controls evolve alongside that. And I've certainly seen examples in the industry now of technology being used here, analysing people's voice patterns, analysing for signs of stress, analysing for where people are using words that are not their natural words. So I do think we have to be really, really careful about vulnerability. And one of the consequences of the pandemic, as Stuart rightly says, is there's going to be real pressure on certain family finances, particularly where younger people have worked in, say, hospitality, and those jobs aren't there to go back for. I'm probably slightly more optimistic in the medium term, because I think that just as technology can allow us to deliver the advice, technology can play a big role in helping us identify that vulnerability. In the meantime, we're going to be very dependent on advisors being perceptive and really spending the time to get to understand the client need and the client requirement.
Stuart, earlier on we heard David talking about the importance or the opportunities for collaboration in this market, about moving forward and collaborating between the different stakeholders to move this industry forward. What's your take on that?
Yeah, I guess, David, I'd be keen to understand who you see as the stakeholders in this. And I guess a second part of the question is, how can we set the standard with those collaborative discussions? Because I think I'm a great believer that if we allow the vacuum to be created where the regulator steps in and sets those standards, it's going to be far easier for us as a sector to lead those standards. So how do we set that bar higher ourselves, and then get the regulator, if you like, to police that, instead of them themselves setting the rules that we then have the challenges of working around?
Yeah, those are both really important questions. And in terms of the key stakeholders, as I was saying in my presentation, really it covers a wide range of stakeholders. When we were dealing with the issues of trying to ensure that the actual pipeline was kept going, and there was a particular attention to the issue of legal advice and ensuring that remote advice was going to be a temporary option. That involved, liaising with all those concerned and keeping in touch with the Bank of England and indeed the FCA, but particularly actually in that regard, it was the Law Society that we had a role to play with. So our stakeholders do cover, and in ordinary speaking, it would mean, for example, myself and others being regularly in touch with the Treasury. The Treasury is someone who we particularly have a close relationship with, as well as the Bank of England, keeping them in touch with the market, as well as obviously the FCA. And particularly in these times we're in at the moment, and with a spotlight from the FCA, there's a a particular role that we have to play to be closely in touch with them. So there's that sort of ongoing stakeholder engagement, as well as a wider engagement that we have, because we cover we've got a big value chain that all have different interests at different times. We had to respond not so long ago to the PRA around the whole issue of the follow-up from the Solvency II issues and how we deal with that. So there's quite a range of stakeholders at different times. But I suppose what I'd want to also say is that we recognise the importance, particularly of our standards. That's a key element to what it is to be about the council, and want to ensure that those standards continue to be fit for purpose. And what Stuart's referencing is how does that fit in? Obviously, we have the regulatory framework. We have that which is required, which is there to provide authorised advice and does play a important role. And also, I mentioned before, the other regulatory PRA involvement as well is also relevant to our sector. And so we have important relationship to play with them, but particularly in terms of the issue of product and advice standards. We in our last revision of our standards tried to ensure that we made it very clear that what is it that we add to in terms of providing supplementary and complementary support to the framework of regulatory framework. And we don't seek to do what the regulator does itself, but we seek to be proactive in providing principle-based and customer outcome standards. And that means we're not just simply about ticking a rule on and trying to say that's fine, that's it. What we want to do is truly ensure that we are driving good consumer outcomes. And so our standards are trying to be on the front foot, as Stuart is suggesting, that we're trying to ensure that we are able to raise the bar in the best interests of consumers. So that's why we have a toolkit that involves the advisor checklist, the good practice guide, and in fact, indeed, those coming into the market, the competency framework. That's all trying to help supplement the regulatory requirements, but recognising, not least with the FCA coming in with their recent report in June and their letters to CEOs, that they want to see that we're properly evidencing that personalised, tailored advice, and that there's evidence properly. So we want to ensure that we're doing all we can to support that good practice in the industry, to ensure that we don't need to, as Stuart says, unnecessarily allow for interventions that raise the bar unnecessarily. But it's a collaborative effort, really. We all want to raise the bar together to those good standards for good consumer outcomes, and that's what we're about.
And then, Steve, I'd just like to ask you, in regards as a secondary part to that, how do you see the horizon for the demographics? Any demographic impacts that we should be aware of coming at us that will impact on those issues?
Thanks, Stuart. And I guess I'll pick up on the demographics. But before I do, I'd just like to say I absolutely agree with you in terms of leading and setting the bar. I think we've consistently seen the equity release industry move to impose standards ahead of regulation and generally apply higher standards than the minimum set in the regulation. I'd like to think that's the long-term outlook for how we police this industry, because I think an industry that relies on a regulator to set its minimum standards is not a very healthy industry. In terms of demographics, there are sort of two or three things I would draw your attention to, and a lot of the base on the demographics is very well known and understood. We have a very large baby boomer generation which has recently hit retirement. There's actually a few features of that which I think are probably not thought about enough. One is the pattern of those baby boomers. So there were effectively two spikes in the birth rate, one immediately post-war, which is now actually moving into care. So the fastest growing part of the population is actually the over 80s. And if you think about the average age that people enter care, it's about 85. So we are expecting to see a big rise in the number of people entering long-term care in the next couple of years. I think it roughly doubles over the next decade. And that's going to create demand for equity release assets to help fund that care, be it care at home or care in care homes. But it also, as we touched on earlier, it creates a whole load of concerns around vulnerability and how you manage the conflicting interests potentially of different generations. So that's the first demographic trend I'd really focus on. The second one is one that's talked about a lot, and I don't think we've seen in volume yet, and that's the younger baby boomers are the first generation that are getting to retirement with debt that they don't have repayment vehicles for. And that's really a quirk of mortgage regulation changing in the 1990s, and particularly interest-only and mortgages being able to be sold without a repayment vehicle in place. So at the older end of this baby boom, we've got care, and care is an issue that we are going to have to tackle over the next 10 years. I mean, fundamentally, the government is going to have to come up with a policy. It's effectively deferred it for 25 years, but we're past that point now. And the second issue I think we really should think about is this wave of people approaching retirement with debt and no repayment vehicle in place. Now, some of them will be well served by simply continuing to service an existing interest-only mortgage until death. I think if they've got large defined benefit pensions, for example, they've got inflation-linked income that will help them do that. But I think many of these people have undersaved for retirement, and certainly as they go through retirement will find servicing that debt is a real stress on their finances. So from my point of view, that's the other thing I'm sort of intrigued by in the demographics, that we've got this big spike at the very old end, and at the younger end, we've actually got the first generation hitting retirement with debt.
And Stuart, David mentioned earlier, he talked about this industry being fit for purpose moving forward. And I guess that lends itself to talk and discussions around not only consumer outcomes, but also advisor development and training and advice outcomes. What's your view on this subject?
Yeah, quite a strong one, I guess. Any chain is as strong as the weakest link. And we've had over the last few years a reference that continues to loop back around the dabblers and this direct association that it's volume linked. So somebody doing a low volume must be a dabbler, and therefore the consumer outcome must be wrong. I'd like to dispel that myth, because it's about attitude. It's not linked directly to volume. So if I was to recommend my own family, my own grandparents to an advisor, I can think of a raft of advisors in the industry that might only do a handful of cases, 1, 2, 5, 10 cases a year, that have an incredibly good consumer focus, and I'd be more than happy to refer my own family to them. But likewise, there are advisors that have the wrong attitude and might well be doing substantial volume, but their consumer outcome isn't maybe as good because their attitude is wrong. So let me put this to bed once and for all. There is not a direct link between the volume of cases that you do and the attitude and standard of consumer outcome. But we must focus on that lowest common factor area, the standard and the attitude of consumer outcome, and how can we work to improve and raise that bar up.
And David, could I ask for your view on what Stuart's just said on this important point around advice outcomes and customer outcomes?
Yeah, well, I agree with Stuart. Certainly, I join him in putting to bed that the suggestion that there's a link, a primary link to volume and whether one's delivering good consumer outcomes. One of the joys of being the chairman of the council is to go out and about. I've had to do it remotely whilst we've been in lockdown, to see that we have advisor members in all shapes and sizes who are providing really good consumer outcomes, and that isn't dependent wholly on volume. It is dependent on attitude, as Stuart says. What I think the challenge is for the industry is that it's not just about ourselves. We're trying to grow, aren't we? This industry has huge potential given the amount of the trillions of wealth in older person's hands, and the fact that it should be in many ways bigger. There's lots of reasons we can think of why it's not, but there's such opportunities given the gaps and growing gaps for those to be able to access proper income and wealth in their retirement, to pay for their retirement. So we need to recognise that and we want to encourage new, as I know Stuart's very passionate about it, of developing new advisors and growing the development and the competency of new advisors and providing the professional development. And that's something which I've seen real growth in terms of that professionalism by partners. And we've been very much recognising that there'll be those coming in, perhaps particularly we're seeing maybe from a wealth management background or from a normal residential mortgage background, who are just seeing the opportunities that this sector has, and also coming in there as lawyer members coming in, surveyors and others. And we're trying to ensure that there's a a broad suite of competence framework. And that's what we have rolled out as well, to complement an understanding that we're not just talking about dabblers, we're talking about people who are just, frankly, new to the market and can learn and gain from the best practice that's illustrated by the small or the large distributors in our market. And we feel we can really help share collaboratively that good practice and ensure that the attitudes are right. But we need to recognise, not least from the FCA as well, that the spotlight is on us, and we need to evidence that and ensure that we are genuinely fit for purpose. And the question that we need to continue answering, I'm sure this symposium is seeking to do, is that we're fit for a later life lending purpose, for the wider retirement planning of a customer that doesn't see itself in some of the silos and some of the separate ways that we can sometimes work in that much more. I know Stuart talks a lot about it as well, this holistic service that needs to be provided, and certainly we need to support that together.
And Steve, the same point to you. What's your view on this issue of advice and customer outcomes?
So when you look at customer outcomes in this space, I do agree with Stuart. It's not an entirely volume-related business. It's actually really about the technical competence and the human empathy that the advisor has. Equity release is an unusually complex piece of advice, and I say it's unusually complex for a number of reasons. It has interactions with a whole load of highly complex and emotive things, such as retirement financing, inheritance, long-term care, and fundamentally, it is something where actually the money you spend today is money that isn't available to you tomorrow. So the advice needs to be done right, and it needs to weigh up all of the conflicting demands that people have. I don't think that somebody doing large amounts of equity release every day is a guarantee that they have those skills or have thought about that and have done it in the right way. Equally, I don't think that somebody doing it occasionally, where actually they may deal with those issues very regularly on other products and in other situations, is a problem. I think this is really about an industry where people have to understand the complexity of the problem. They have to put the customer and the customer outcomes right at the heart of what they do, and they have to communicate really clearly with customers, because ultimately customers here are having to make difficult choices. They're making choices between, do I spend the money today, or do I not do what I want to do in retirement, hold back that capacity? And obviously there's no guarantee that they will reach tomorrow, or that tomorrow will be reached in a decent state of health. So I don't think there is necessarily a right and a wrong answer for any group of customers. I think for each customer it's highly personal. And in my experience, the best advisors are the ones who combine all of the technical knowledge and experience and competence you get from the examination system with the human empathy to really understand what's important to their client and what it is that would really make their client happy in the medium to long term, because that enables them to weigh up those trade-offs and find the right balance for the customer.
Thank you, David and Steve, for joining me today to discuss this topic. And if you have any views or thoughts you'd like to share on what you've just heard, please do get in touch on social media using the hashtag #SymposiumLive. And don't forget to use the question and answer feature on your dashboard to pose your questions to our guest speakers here today. We have our live Q&A session at the end of the event, and we'll be answering as many of your questions as possible. Now, before our next debate, we'll take a short break. We'll be back in just 5 minutes to get an advisor perspective on the later life market, when Stuart and I will be joined in the studio by Paul Soraya of Viva Retirement Solutions and Mark Orme from the Equity Release Experts. And we'll leave you with this question. In 2020, what was the average amount of equity released for gifting purposes? We'll be right back with the answer and more guests right after this.
Ready to thrive in the later life market? Air Group has everything you'll need to realize your potential with the help of 3 market-leading propositions. Grow your business and enhance your income with Air Mortgage Club. Become a member today and you'll benefit from access to exclusive products and deals, enhanced procuration fees, and unrivaled support from our knowledgeable team. Air Sourcing provides trusted, accurate and timely product sourcing technology, and with fully live rates and knowledge bank integration for enhanced criteria searches, Air Sourcing is the most comprehensive product sourcing platform in the market. Boost your professional development with the Air Academy. Fully accredited by the London Institute of Banking and Finance, you can have confidence in the Academy to develop your advice skills. Join Air Group today and start maximising your potential in this growing market. Contact our dedicated support team to find out more. Air Group, your trusted later life services platform.
So, what have you got for me?
Well, advisor, we know that no two clients are alike, and we want to equip you for every mission. So we've designed a huge range of lifetime mortgages to give you the flexibility to recommend the right plan for each client.
Flexibility is my middle name.
It isn't, is it? Your middle name's Leslie. Right, as you'll see here, we're providing you with a wide choice of plans you can recommend. High LTVs, competitive rates, a range of drawdown and lump sum options. And there are modern features, partial repayments, fixed early repayment charges, downsizing protection.
Wait a minute, Q. Have you got a pen?
Yes. Select your weapon of choice. No, not that one.
What? Does it explode?
No, it's just, that's my favourite pen. Just choose another one.
Key Partnerships are one of the UK's leading equity release referral specialists. We work with your clients to unlock the financial potential in their home and secure a more comfortable retirement. The process couldn't be simpler. You refer, we chat, we advise, and you earn. To find out more about equity release referrals or how we could support your business, give us a call on 0800 138 1663 or head to our website keypartnerships.co.uk. Key Partnerships, the equity release referral service.